Walk through a downtown today and you'll see them. Dark floors, empty lobbies, space-available banners. It looks like a city problem. It's actually a banking problem. And there's a wave of loans coming due that could test how serious it gets. Here's the reckoning and the reasons it might not be the disaster some fear. The numbers are striking. San Francisco's office vacancy hit about 36.7%, more than a third of its space. In Seattle, the space companies are trying to offload to others jumped around 22% in a year. Remote work and leaner, AI-assisted teams simply need less office than before. This is structural, not just a bad year. Now the timing problem. Most commercial property is bought with loans that come due every few years and must be refinanced. A huge stack of these loans was taken out before 2022, when rates were near zero. They're now maturing and have to be refinanced at today's far higher rates, against buildings that may be worth less. Higher payments on lower value buildings. That collision is what people mean by the maturity wall. Here's why this lands on banks, and specifically regional banks. They hold an outsized share of these commercial property loans. If a building's value falls below what's owed, and the owner can't refinance, the bank can be left holding a bad loan. Concentrate enough of those in mid-sized banks, and you have real stress on their balance sheets and their willingness to lend to everyone else. But the doom story isn't the only story, and the honest version includes the pushback. After 2008, regulators forced banks to hold more capital as a cushion. Loans are often being extended and written down slowly, in a managed way, rather than blowing up all at once. Many analysts see a grinding drag on bank earnings. Painful, localized, rather than a sudden, contagious crisis. Serious risk, real disagreement about severity. And here's the genuine twist. That 36.7% vacancy was actually the peak, reached last year. And San Francisco has since started stabilizing, posting some of its strongest office leasing in years. The driver? AI companies expanding fast and grabbing physical space. The same technology blamed for emptying offices is now, in one city, helping refill them. The story is still being written. So, empty offices are a real risk that flows straight into regional banks through a wall of maturing loans. But stronger capital rules, managed write-downs, and an unexpected AI leasing rebound all argue against a 2008-style panic. Watch it as a slow-motion stress, not a countdown to collapse. Money Unwrapped, where we measure the risk instead of just fearing it.